Welcome to the webinar Trading Psychology and Discipline with Thomas. I'm Thomas. I will be the one hosting the webinar today. First of all, I will tell you a bit about myself. I'm senior account manager here in AvaTrade. I've been working for the past few years with many clients, and I got the chance to understand what are the main difficulties that traders are having, and I will be able to share with you today some of the common mistakes that traders are doing, and share some of the main questions that I'm getting from many clients' experiences throughout the year. And I hope this webinar will give you some insights and will assist you with your trading journey and help you to improve it. I will start with the risk disclosure. Any capital markets and trading information disclosed in this webinar is provided for informative purposes only and should not be considered or applied as investment advice, recommendation, or suggestion. CFDs are complex instruments and come with a high risk of losing money rapidly due to 57% of retail investor account lose money when trading CFDs with this provider. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Please read full disclosure statement on our website, AvaTrade.com. Now we can start. So webinar agenda, what we will be discussing today. First of all, we can discuss trading psychology, mindset fundamentals, common mistake, emotional control tools. This is one part of the webinars that we have already covered previously, while the other part is profit and loss calculation, order types, opening and closing position, pending orders, margin calculator. So you can decide if you want. You can let me know in the comments whether you would like to focus today more on the psychological part of trading, or if you would like to execute a little bit of trading on the WebTrader. We can cover more the part relevant to stop loss, take profit, margin calculator. Basically, our webinars are we're doing rotation between the two. So if you would like to, if you have a certain request, which one of them you prefer. If not, today we will be rotating between both of them. Okay, so first of all, when you are logging into the website, this is the WebTrader page. When you go to the website, AvaTrade.com, you'll be able to see on the left top, my account, payment, tools. When you click on my account, accounts, you'll be able to see add an account. And here you can set up another real account if you wish to have a few different accounts, MT4, MT5, or options. And here you can set up a WebTrader account, which is pretty much the same, just the WebTrader account connects you directly to our web trading platform. Here you can see there is a difference. That this is a very important question that people are asking. What is the difference between MT4 and MT5? The main difference is that MT5 have a trailing stop. This is another tool that is not available on MT4. Additionally, you have a larger selection of stocks that we offer that are available only on MT5. And additionally, I will also show you that we have nano lots that you can trade on some instrument, also available on MT5 only. So this is your consideration, whether you prefer to keep using MT4 or you want to switch to MT5. In terms of the functionality itself, MT5 is very similar, almost the same. Just have a few added features. So this is how you set up another account, and the reason why some traders decide to set up a few accounts is, first of all, to divide one account they wish to trade, let's say, currencies. One account they wish to trade indices. One account they wish to trade commodities. So first of all, you can have a few different live accounts to have a better division between each account. Another good reason to have different accounts is one account you make the deposit. Let's say I deposit to account ending with 703, okay? And then I keep the money here like a certain bank, okay? And I transfer money from the main account to the other account. So I always have margin on this account, and whenever I need to inject some margin to protect my position, or let's say I want to trade, so I transfer money from the main account to any other account. So just for you to know what are the main advantages of having few different accounts is mainly to have a different strategy on each account, and also one account you can keep money and you can share it with other accounts by we have a button called internal transfer that you can actually move money between accounts using the internal transfer button. You'll be able to see it under payments when you have a real account, regular account. So this is just a little bit of information about the difference between account types. So this is the main page of the WebTrader. You can see it is divided by different sections here. A hot, most rising, most falling, most buying, most selling, forex indices, crypto, commodity stocks. If you click on hot, it's going to give you some different trading ideas that are basically trending instruments. So you have US 500, US 30, US Tech 100, US 2000, and gold. Okay, so these are the American indices. This is gold, the commodity, and also here you have euro dollar, pound against the dollar, USD JPY, the Bitcoin. So if you don't really know what to trade on, always you can click on these options to see different trading ideas. Here you can see, for example, copper, some different stocks, was falling as well. You can see different instruments, SAP, and same thing here, most buying, most selling. And also here, when you click on Forex, you can see all of the instruments, the currencies that we do have available to trade. We have here the trading overview panel. We have the balance, the free margin, equity. The balance represent your close position. So when you close the position, the balance will be adjusted accordingly. The free margin represent the amount of money you have in the account to place new orders, and the equity represent the real value of your account, including your open positions. In terms of mindset fundamentals, when we talk about the psychology of trading, what are mindset fundamentals? Mindset fundamentals are the core psychological principles that shape how traders think, react, and make decisions in the market. They determine how well a trader handle the fear of pressure, risk, and uncertainty, different emotional triggers. A strong mindset help traders stay disciplined, follow a certain plan, and avoid emotional decision, while a weak mindset lead to impulsive trades, inconsistent result, a repeated mistake. Even if the trader uses a good strategy, it can cause to enhance odds of losing money due to the psychology part and the mindset part. Mindset fundamental create the foundation for emotional control, discipline and patience, proper risk taking, consistency in following your plan, the plan that you set, clear decision making during volatile market in trading. Psychology often influences results as much as or even more than analysis. So this is a very important part that we will be focusing today. Strong mindset is the foundation of every successful trader. Fear against greed. I'm sure that every one of us as traders always come up with this different conflict that always you will be having the greed of wanting to make more money and a fear of losing money. That's why you set a plan in advance. So you have a strategy set up and you just need to follow it. Fear and greed are the two strongest emotions that influence trading decisions. They often push traders away from their plan and into emotional, impulsive trading behavior. Fear shows up as hesitating to enter good positions, closing winning trades too early, avoiding opportunities after a loss, exiting positions too quickly during volatile market. And greed shows up as increasing position size after a win, holding trades for too long, ignoring stop loss rules, chasing fast moving markets without a plan. A balanced mindset helps traders avoid emotional extreme and make it clearer and more consistent in terms of the decision making process. A FOMO, fear of missing out. I'm sure that everyone is familiar with that, and you also see it when you are trading. Let's say you missed a big opportunity and you were afraid, let's say, to get into a position, and then you feel the fear of missing out. You feel that you missed out on a good opportunity. So FOMO is one of the most common psychological traps in trading. It pushes traders to act emotionally instead of following a certain plan. How FOMO appears: entering trades too late because the market is already moving, jumping in without confirmation or analysis, copying other traders or reacting instantly to news, feeling pressured to not miss out on any move. What is the main cause for FOMO? Seeing big candles or strong market momentum, watching other make profit, reason losses or frustration, lack of patience or confidence in trading and in your strategy. FOMO leads to impulsive entries, poor risk management, and inconsistent trading results. Traders reduce FOMO by trusting their plan and accepting that missing a trade is perfectly fine. So again, this is very important sentence that as a trader you need to have a plan and you need to learn how to follow the plan, because this is the way that you can improve your trading journey and become better in trading. So it's not always about the analysis. Many people focus only on the analysis and how to analyze the market better, which is very important as well. But today we will be discussing more the discipline part, the psychological part. The next subject is discipline and patience. Okay, so discipline and patience are two of the most important skills in trading. They allow traders to follow their plan, control their emotion, and avoid impulsive decision. What discipline means: following your strategy consistently, respecting your stop loss and take profit level. It means that if you have a stake profit and stop loss that you set in advance, So you can keep it, because if you keep it, it means you follow the strategy. But if accidentally, obviously it's not accidental, but if you decide to remove your stop loss and remove your take profit, so then you change your plan, which is okay, but it's better to decide in advance and to follow a certain strategy. And if removing your stop loss and your take profit level is in accordance to your strategy, so it's good. But if in the first place, the reason why you set your stop loss and take profit is in order to get out of a position, so you better respect that take profit and stop loss. Keeping position size under control. So this is also a very important subject. If you visited our previous webinar, we discussed a lot about how to set a position with a full exposure, which means a very big position where you use all of the margin in the account. And we also discussed how to set a smaller position, how to set smaller exposure. And for you as a trader, it depends on your trading style. You can trade on a conservative approach, and you can trade on a bigger level of risk approach, where you put a bigger position and you can make more profit, or you can have more losses per each point the market moves. Avoiding revenge trading after a loss. So again, we all know that when you are trading and you have a loss, sometimes you want to keep trading and you try to win back the money that you lost. But this kind of behavior is not really in alignment of a good trading strategy and a good discipline, because then you are acting out of emotions and you're not following a consistent strategy. Not trading when market conditions are unclear. It means that if there is uncertainty in the market, if you don't really want to trade, so it's better for you to not trade. Although that when the market is moving, there are a lot of opportunities as well in the market. So again, we go back to the plan that you have. Whether you should open the trade or not is based on the plan that you set. What patient means waiting for high quality setups, not trading out of boredom or frustration, allowing trades to develop without micromanaging. It means that if you decide that you want to hold a position for, let's say, few months or few weeks or few years, you open the position, you let it run. Micromanaging means that if you open a position, you already have a strategy in line, and after you change your plan, so this can cause you to increase odds of losing money because you're missing out of the original plan that you set. And sometimes it takes the market some time to correct itself toward a certain point. So essentially, it's better for you to set in the beginning when you're going to close the trade after a loss of, let's say, 1%, 5%, 10%, or whatever amount that you decide when you want to get out of the position, accepting that not every day offers good opportunities, which means not always you need to open trades. Depends on your strategy again. Traders who develop discipline and patience create long-term consistency and avoid emotional mistakes. Common emotional triggers: sudden profits or losses, large market movements or high volatility, news events and unexpected spikes, losing strike or a big win, personal stress, tiredness or distraction. How emotional triggers affect traders: overreacting to short-term price movements, closing trades too early or too late, increasing position size emotionally, entering trades without analysis, breaking risk management rules. So as you can see here, this is a lot about emotions and psychology and what are the main things that causing you as a trader to make mistakes. What are the main things and emotional aspects that are actually causing you to trade or not to trade or to open too many trades and to eventually miss out on a strategy that you managed to plan in advance. Risk perception. Why risk perception matters? Traders often underestimate the danger of large position. High leverage increases emotional pressure and stress. Smaller position size allow clearer, more rational decisions. For this specific factor, the trader, each one of the traders are able to manage the risk portion prior to opening the trade. So if you trade on a bigger lot size, or if you trade on a smaller lot size, you are the one who's managing the account. And if in the beginning you set a certain perception where you want to trade on a high risk, or whether you want to trade on a low risk, both of them are good. The question is whether in the beginning, when you are trading, you know what kind of risk portion you want to have. And I will share with you an example before we go back to the presentation. If I want to trade on, let's say, gold, okay? I want to trade on the smallest one, 0.01 lot, okay? So it means that if the price of gold reach, let's say 5.6, I'm going to make $80, okay? But if I want to trade on a bigger exposure, I want a bigger risk as well, I change it to one lot. So I'm going to make $8,000. And if I'm going to change this one to 10 lots, so I'm going to make $81,000. And if I change it to a bigger one, let's say 50, in that case, I will make $400,000. Okay? So this is an example of being able to navigate throughout your position size and being able to decide what kind of risk management you wish to have on your position. How poor risk perception shows up: overconfidence after winning a strike, taking larger trades to speed up your profits, ignoring loss levels, believing a trade is safe based on emotion, not analysis. So over here you can see that if you set your plan to set up, let's say up to 2 positions a day, 5 positions a day, 10 positions a day, or even 1, 2, 3 positions a week, it doesn't matter. The main thing is that you follow whatever you plan to set. And it is okay to have 5 positions, 10 positions, or 1 big position, or a few smaller positions, whatever you think that is the right strategy for you. Healthy risk perception means respecting position sizing rules, which basically means that if you want to risk a certain portion from the account, you can go here and you can do the calculation. If I trade 0.05 and the value of gold reach, let's say 550, I'm going to lose 114. This is the fact. So if you have this position, the price of gold reach 550. So this is your possible loss. And if it's going to reach 5400, your possible loss will be 600. So this is something also to take into consideration. Okay, that you have a respect for your position sizing rules, and also you can set a certain risk portion. Understanding that losses are also part of the process. Managing leverage carefully. The leverage determines basically the size of position that you can open. That's the meaning of leverage. So if you have a leverage of 1 to 400, or if you have a leverage of 1 to 30, what is the difference? Is that with a higher leverage, you can open more positions, okay? But the main thing here with the leverage is that it determines how much money is required to place the order. So if your account has a higher leverage, it doesn't mean you need to take a bigger order. It means that you can use it and just open the same order that you would have opened anyway. So also the thing with the leverage is also something to do with the mindset fundamentals, that even if your leverage is high, you can still open smaller orders, and it means that your margin will be higher because then you have room in the account to keep the open positions. Making decision based on probability and not on emotions, which means taking informed decisions based on a certain rule that you set to yourself. Confidence versus overconfidence. Confidence is a trader ability to trust your strategy and follow your rules. Overconfidence appears when a trader become too certain, ignore risk, and stop respecting their plan. What healthy confidence look like? Following your trading plan consistently, taking trades when your setup appears. Setup means that if you decide to open a trade based on, let's say, Bollinger Bands or stochastic or RSI, a certain technical analysis indicator, so you clearly know when you should be opening the position. It's written down very clearly. Okay, so this is a setup. Okay, respecting stop loss and position sizing rules. Again, we covered this one. To be honest, if you set a stop loss, I will share with you. If you set a stop loss here, 5400, for example, and when I open the position, okay, you can see the stop loss 5400. What it means that the system will try to execute closure when the price reach the price that you set. So again, this is something relevant with the stop loss. Accepting both wins and losses calmly. What overconfident look like? Increasing lot size after a win, taking trades outside your strategy, ignoring stop loss levels, believing the market won't go against you. Why this matters? Confidence lead to discipline, stability, and long-term consistency. Overconfidence lead to large losses, emotional decisions, and broken rules. A balanced trader should remain confident without letting success turn into recklessness. And I will give you an example from our previous webinar last week. I gave you a random example how to hedge a trade on Palladium. We opened 2 positions. You see I'm fully hedged on Palladium. 10 size of Palladium sold, 10 size of Palladium bought. One position is winning with $2,800. One position is losing with $3,100. I let this position be open from the 15, okay? And this position is also open from the 15, okay? So you can see this is open nearly 2 weeks. Now, My strategy was to do a hedge position on these two positions. And then after some time, when I decide to close my position, I close it with the profit. And now I go back to the same position. I choose the same position sizing rules, 0.1. I go back just to check to confirm. This one was a sell. So you see here 0.1 buy. And we are going back to the previous webinar, where now we have again a fully hedged position. Okay, you can see the same size, the same instrument, different direction, one buy, one sell. One is losing, the other one is also losing now, but basically when you are hedging, then the prices change. So if this position, the buy position, will go into more negative, it means that the sell position will go into more positive. I'm still in a loss because of the previous position was, you can see here, the history, the previous position was closed in a profit of 2,778. So I'm still in a loss. Also, the spread is something to take into account. But the point why I'm showing you this, because this was the strategy. Strategy was you open one buy, you open one sell, and then you keep it for some time to check what is going to be the market movement. And you can see that the price did not change a lot due to the main fact that I was fully hedged. The price did change, but the numbers, the P&L didn't change dramatically other than the spreads, which is the difference between the buy and the sell price. Okay, so we went through the overconfidence, increasing lot size after win, taking trades outside your strategy, ignoring stop loss levels, believing the market won't go against you, and another common trading mistake, revenge trading, entering new trades immediately after a loss to try and win your money back. Over trading, taking too many trades, trading out of boredom or forcing different setups, moving stop loss levels again, adjusting your stop loss further to avoid taking a certain loss, which basically means that if you are losing a certain amount of money that you set in advance that you will not lose more, then you decide to change your stop loss level after you originally set it up according to your risk exposure. Closing winners too early. So you're selling profitable trades too quickly due to fear of losing your gains, letting losing positions run, holding losing trades and hoping they will reverse instead of respecting the rules that you set, impulsive entries, entering trades without analysis, confirmation, or a clear plan. These mistakes are common among both beginners and experienced traders. The key is recognizing them early and building discipline to avoid these mistakes. Emotional control tools help trader make logical decisions instead of reacting impulsively. Simple technique, reduce emotional trading and improve consistency. 5-second pause rule, pause 5 seconds before entering or adjusting a trade to break emotional impulses. So if you want to close a trade, or if you want to open a trade, or if you want to adjust a certain stop loss, take profit, hold a few seconds, and think whether this is something that you're doing out of emotions or you're doing out of strategy. I also advise to keep a trading journal that you can actually record every decision-making process that is causing you to change a stop loss, change a take profit, open a trade or close a trade. You should have different things written down so later you can analyze it. Breathing reset, slow, deep breath to calm the nervous system and reduce stress during volatility. Cool down periods, take short breaks after big wins or losses to avoid revenge trading or overconfidence. Structured decision making, use checklists or rules to answer key questions before entering a trade. Emotional detachment, treat each position as one of many, not something personal, to reduce emotional pressure. These tools help traders stay calm, focus, discipline, even in fast-moving markets. A few different examples could be, first of all, hedging. So if you hedge a position, you know that one is going to go up and one is going to go down. You are actually limiting your loss to a certain extent. So also hedging is something that some people like to use as a strategy. Another tool will be the take profit and stop loss. These are the triggers that will be closing the positions. And also, you can set your pending order. So also something that you can use to detach the emotional part is that you set a position and you build the position before you get to a certain market price. Okay, for example, I ask the system to open my position at 5500, for example, and I decide in advance that I want profit of $50. I want to have a loss of up to $100, and the system tell me under what values my profit or loss will be around what area, and I execute the position, and I can let it run because the position will be open automatically if it will reach the value that I set, and also it will be closed automatically according to my take profit and stop loss values. So this is also a strategy that you can implement in order to cool down and have a more clear way of implementing trades. By the way, if you have any questions, I didn't see any questions on the chat box. You can feel free to ask questions and I'll be happy to reply and answer your questions. Routine and discipline, strong routine and discipline habits help traders stay consistent and avoid emotional decisions. Good trading is built on a certain structure and not based on luck. Pre-market routine, review market conditions, key levels and planned setups before the trading begins. Trade journaling, record entries, exits, emotions and mistakes to identify patterns and improve over time. Daily loss, set a maximum loss for the day to prevent emotional and reckless trading. Consistency, habits, follow the same rules, time frame, and process every day to build a certain pattern and to build stability. Sticking to your plan, execute only when your setup appears and avoid trades outside your strategy. Routine and discipline allow the traders to stay focused, avoid impulsive behavior, and build long-term consistency. Case studies, real trading examples help traders understand how psychology influences results in practical situations. Always you can gain more knowledge about trading. You can find thousands of different case studies about trading and also follow the whole psychological part. You have thousands of books about trading that you can always read and always gain more and more information. Psychological failures, a trader increases a lot size after a win, become overconfident, take a large loss. Another trader moves stop loss repeatedly, turning a small controlled loss into a big emotional one. Discipline mistakes, a trader enter multiple trades out of frustration after a losing strike, leading to overtrading and more losses. Another trader exits winning trades too early due to fear, missing long-term profitable positions and opportunities. Success through discipline. A trader follows their plan, respect their stop loss, and maintain consistent position size, leading to steady long-term results. Another trader journals each position, identifies emotional triggers, and reduces impulsive decisions over time. Key lesson, the strongest traders are not those who predict the market perfectly, but those who control their emotions and follow the rules consistently. So we got a question here, when to hedge? It is difficult to decide the timing to hedge. Any guidelines? For you as a trader, this is something that we have discussed. You decide what is your own strategy. And in terms of hedging, you can open a hedge position whenever you want. The question is what you do after the hedge. So as we spoke about last week, I gave a few examples. I was hedging positions while the webinar. So maybe you did not visit our previous webinar, I assume. Maybe next webinar we go through hedging again. Okay, I was opening a few positions for the example. I wanted to show the trader how to hedge. So let's say a 0.5 lot on gold. My free margin is not allowing me to open the position. It means I have too many open trades at the moment. So let's say I have here one buy position with a loss, which basically means that my position went down and I made some loss on it. So what you can do after that, you see that you have a certain percentage of loss, you could hedge the position and you basically secure yourself with a better pricing point. So this is the purpose of hedging. So let's say I open gold, sell 0.05 for the sake of the example. I execute the position, and now what happens is that I have one position 5 lot, a 5 size on gold and buy and one sell. If the price went down here, you can see that you have a certain loss. And now I open a sell position, I have a certain loss. I close this position. And what I meant to say here is that in order to secure a better pricing point, this will not be an hedge. This will be just to open another position. And now you can see over here the difference in the pricing point. While this position you open at 5548, here you basically got a better price, 5518. So it's not necessarily related with hedging, okay? Here you just secured a better pricing point, but you can do hedge when you want to have a certain limitation to your losses as well. So I'm teaching you the strategy so you will know what kind of options you have available, because many traders are not really aware. And by the way, if you're interested in hedging, the rule for hedging, you need to have more than 100% in your margin level. Trading journal, keep a trading journal, help you as a trader to improve your self-awareness, discipline, decision making, what to record, entry and exit, price, setup, and reason for entering the position, risk, stop loss, and position size, emotions before, during, and after the position, mistakes made or rules broken, what you learned from the trade, why it matters, identify emotional pattern, help avoid repeated mistake, build confidence in your strategy, improve consistency and discipline. A trading journal is one of the most powerful tools for long-term psychological improvement. So this is a recommendation to anyone to keep a trading journal and to journal your trades. An example, you see here, this is daily journal. You have the position, the date, the setup, the entry, the stop loss, take profit. You mentioned the reason why you opened the trade, emotions you had, the outcome, the mistake, the lesson learned. Trading journal example, weekly summary that you set, total positions, win and loss ratio, main mistakes, main improvements, goal for the next week, a win ratio, monthly return, strengths and weaknesses, psychological progress, yearly summary, annual growth, best 4 months, biggest lessons, focus for the year. So basically you see here you're keeping yourself with a record so you can keep improving and become better and better on a daily, weekly, monthly, and yearly basis. And another example, weekly trading journal, the week, the amount of trades, the win and loss ratio, the mistakes you had, the improvements you need to improve upon, the goal that you have for next week. Example for monthly, the month, the win ratio, monthly return, the strength, the weaknesses, psychological progress you had, a yearly, the year, the growth, the best month, the worst month, the biggest lessons you had, the focus you want to keep for your next year, and Q&A. So connecting psychology to real trading, answering questions and address common challenges, fear, citation, overtrading, impulsive. So basically for this, I can let you know that psychology is a very, very important part of trading. And throughout the years, I noticed that a lot of traders, they have a big issue with that. And this is something that each one of you should keep a journal and decide that you want to improve that part of trading, where you basically open trade based on your plan and not based on your emotions. And this is very, very important tool that each one of you can implement. The analysis part is also important, but it is not as important as the psychological part, because the analysis you can keep improving, and the psychology you should improve in advance, and it will allow you to have a better trading results. And It will allow you to set better systems for your trading, and obviously keep learning and learning and learning and improving your strategy as you go. Benefits when you work with an account manager, AvaTrade, we do have account managers, and each one of you can request a call from an account manager to give you some more clarity about the platform and also give you some different ideas on how to improve your trading. Normally we do offer account managers above $1,000 accounts, but you can always request for an account manager to call you back if you need assistance. And also we do offer VIP accounts that you get some people with more experience to assist you. Easy access, and obviously it's part of the service we do provide in AvaTrade for our clients. I hope you enjoyed the webinar today, and I hope to see you in the next webinar. Next time we will discuss more about trading execution, but also we will try to mention the psychological part, or if you have any requests, special requests, you can request it in the question and we can go through it. So was nice talking with everyone, and I hope to see you next week in our next webinar. I wish you all successful and fruitful trading journey, and all the best, everyone.